welcome everyone. As Blair said, I'm Lindsay Bell. I'm the Chief Markets and Money Strategist at Ally, and you guys are in for an amazing treat. We have such a great group of panelists here to talk about ESG. And as Blair said, the name of this panel is the misalignment between values and investing. We've been getting that wrong lately, and I think investors are noticing, and we're going to talk about how we can correct that as a community, as an investment community here. And these four are exceptional experts, and I'll go ahead and try to pronounce your names correctly from left to right here, my left to right. Ari Polychronopoulos. He is the head and product. He's the head of product management and ESG at Affiliated Research. Yes. Research Affiliates. Sorry, I apologize. I don't have the names, the notes in front of me. But then we got Zach Conway, who's the CEO of Seeds. Then we have Yasmin
Diabilger.
I'm sorry. She's the head of ETFs at Engine Number One. And Gabe Rissman, who is the co-founder and president at Your Stake, which he has a booth right here if you want to learn more afterwards. But you're going to learn a lot on this stage right now. I think what's happened with ESG or sustainable investing, whatever you want to call it, it has a lot of different names these days, is that people, it was this hot topic, right? A lot of money was flowing into it. People were investing in it without question. But now that's changed. It's become one of the hottest debated conversations on Wall Street, right? There is more debate about it. There's questionability about the viability of this investment strategy. And so I would just start with, how the heck did we get here, right? Because it was so popular, and it's still very popular, and it's something that customers, consumers, clients really want. But why is it being brought into question now? Zach, let's start with you.
How did we get here? So I would say 100+ years of people wanting to just have their money better aligned with how they viewed the world and what was important to them. Mm-hmm. And I think, in the last decade plus, we've sort of created this singular idea of what that is, and then a three-letter acronym to kind of bring it to life in the industry. And I think that was kind of a pillar that we could all kind of march toward as a kind of singular idea. And we're at this inflection point because this three-letter acronym is not one thing. It's extremely complex. It essentially means, taking different approaches to apply risk mitigation or some form of values alignment and ingesting data and doing that in a bunch of different ways based on, what the manager is trying to do or what the end investor client is trying to accomplish. And since we've, just now have a three-letter acronym to define all of those things, I think that has created a lot of confusion in the industry. And now we're at this inflection point to try to unwrap what does it all mean and how do we take the right approach as an industry and as advisors and as investors.
Gabe, it's like we've hit this speed bump in the road, okay? Is it a marketing tactic? Like Zach almost was talking about it in that way, like it's a marketing tactic. We labeled it ESG, but what is it? There's a whole range of things that it really could be. But is it a good time to hit a speed bump?
I think so. Is my mic working?
Can you guys hear? I'm actually going to move because this mic or the speaker is like in my ear. Go ahead, Gabe.
Yeah.
Sorry.
So I think speed bump is exactly the right way to describe it. As Zach was saying, there's been hundreds, not just 100, hundreds of years of people looking to align their investments with their values. Really started maybe even in the 1600s with religious movements. And what we are moving towards now is a confusion around definitions. And that's what the speed bump is. And there's kind of pushback from both sides. So side number one is saying, hey, we had this promise of a better world. We had this promise of ESG being able to take someone's values and put them in an investment solution that aligns with those values and actually delivers something that's more than just returns, but personal values alignment and a better understanding of who you are. And what we've done from there is a lot of energy and excitement and momentum and demand for ESG, right? There's that survey, 85% of people want to align their investments with their values. So there was this big rush now that the technology and the definitions were there for advisors and for fund managers to take advantage of that and to call what they were doing ESG. And what that led to was a lot of times trying to cast the broadest net in terms of marketing while applying solutions that were not always matching what people were looking for. And that's kind of the pushback from one side is greenwashing now, which is a term that means your marketing is outpacing your actual practices when it comes to ESG. And that came from this big gold rush opportunity of demand and a lot of scrambling for how do we position ourselves there. And then on the other side, there's now pushback from the other side where, hey, ESG is not something that I want my advisor to push on to me. And what we think is a speed bump is right now there's this reconciliation of a lot of people are looking to align their investments with their values. The first solution was a broad ESG means everything to everyone. And what we're moving towards now and where there's a lot of transition and where it's tricky is moving from ESG means everything to everyone to, yes, we still have our core values. I still want to invest in alignment with climate change or racial justice or Catholic values or whatever it might be. But being more specific about what that means and not having one size fits all, I think will take us in a better direction going forwards.
So how do you do that in a scalable way? Ari, maybe I'll go to you for that because, you know, a lot of times to your point, it's been these indices or ETFs that track broader indices where we're just excluding certain things, but they're still market cap weighted. So, you know, the regular investor is like, hey, I don't believe in what energy companies are doing, but I'm still invested in them in these types of products. So how do we make things more suitable or more to fit the preference of some of the clients that we have out there in a scalable way, though?
Yeah, I think the solution there, and I'm a big advocate of, and something actually Gabe's firm does, it's direct indexing. If you have, I think ESG is a very preference-based investment.
Yeah.
It's not like I want a value index or a momentum index, and I just go buy an ETF and I'm going to get that. With ESG, as Zach and Gabe said, it has a varied amount of definitions. It means something different to every person, and in order to get that, a standard ETF that just takes a broad cap index and tilts a little bit towards good ESG scores isn't really going to achieve much of anything, in my opinion. If you want your values to be aligned with your investment, I think going the direct indexing route, working with advisors who can provide those types of services is really the way to capture what you want to accomplish in your investment strategies.
Yasmin, how about you? What do you think that the product of the future looks like?
Well, I think there's a lot of evolution that needs to happen in this space. So the predominant way of investing in ESG up until now has really been focused on this idea of rating companies and ranking companies, best to worst. And a lot of the issue areas come to that methodology, in my opinion, because number one, it goes to this personalization point. What's good to me may not be what's good to you. I think the S&P 500 ESG exclusion of Tesla is the best example of that. That was a heated debate. Some people say Tesla's doing a lot for the environment. Some people say there's issues with racial equity and workplace discrimination. And so we're going to have a different opinion. But I also think I think we've got to move beyond just values to actually value. And this is where I think the conversation has really been challenged, is that most products in this space have been completely delinked from performance altogether. Most of it has been about impact alone. And my opinion would be that actually many of these issue areas and environmental and social issues are actually related to a company's ability to generate value. We're just not talking about it that way. And so what's the challenge? End customers don't want to feel like they're giving something up. Yes, they want to invest with their values. It's important that their money works for what they believe in, but they don't want to give up performance. And we know that, and I think the last 8 months has really made that hard for people because most ESG products are, as we know, underweight oil and gas, overweight technology. And so until we crack the code on bringing these things together to link material, environmental, social issues to a performance conversation, I think we're going to be muddling along where people have this perception that there's a trade-off to be had. And I think that may be one of the next evolutions of products, is how to actually think about how sustainable investing fits in a broader investing framework as opposed to what we've been doing to date, which is making it its standalone bucket on the side.
Right, and so I think to that point, I'll continue the conversation on that question in that It's always been exclusionary. Like, I don't like what oil companies do. Their drilling is no good, but I do like electric vehicle companies because they're much more friendly to the environment. So I don't want to. I want to take all the energy out of anything any product that I'm investing in. Is it time to evolve that thinking, and maybe you do it with direct indexing and things like that?
Is that for me?
Sure.
I'll
You can
take it
start
because
and then
we are an engagement-focused firm. So full disclaimer, this is what we believe in. As some backstory, we had a campaign last year where we were able to place 3 people on the board of directors of ExxonMobil, which is one of the largest emitters in history. And that was a very interesting example where we owned 2 basis points of that firm when we launched our campaign. But we're able to have tremendous impact. Why? We focused our argument on how what we were suggesting was good for the company and how it would drive shareholder value. And because people hadn't divested Exxon, we actually had over 50% of investors vote alongside with us. And so I think the question of engagement is now becoming more and more of an important topic. 75%, if you care about climate, let's just stick on that issue area for a second. 75% of global greenhouse gas emissions comes from 3 segments of our economy: energy, transportation, and agriculture. That is the heart of the energy transition. And to get even more focused, 80% of those company emissions are coming from just 200 companies. So divestment is the idea of, I don't like it, I don't own it. But how about in a world where you say, I own and engage? Because one of the underspoken about topics in this space is the value of you as an owner. You as a shareholder have a lot of power, particularly collectively, as you vote and as you engage through your managers at companies. And so I think there's a lot of interesting now work happening on what one can do to drive change as a shareholder. I think it's also very energizing for end retail investors because it puts them in the driver's seat, right, to be part of the change that they want and the transformation that they want.
But then there's the part where we have to educate the individual investors that they can do that they have the power, and that's almost the exciting part about investing is that you actually own a piece of this company and you have a say in what they do going forward. Zach, maybe talk a little bit about that. I don't know if Zach or Gabe, which one of you want to kind of...
Yeah, I'll jump in. To kind of go big picture again, I think we talked about ESG is many things. It's different investment approaches. It's what you're doing at your firm. It's direct indexing. It's all these different applications. You could have a singular idea in an ETF where you're screening something out. You could be in a broad-based index that's an ESG index that doesn't have Tesla but has Chevron because that's a structure where you're still getting exposure to the S&P weights of the sectors, right? And so there's all these different applications. It's been narrowed down to this singular term. I think as an industry, we need to recognize that, right, on that side of what is the investment application and all those different applications. But then on the other side, it's the advisors and the industry asking the end investor, what do you want? What's actually most important to you? Do you want the broad-based S&P sector exposure? Yeah. And therefore, you're going to have Chevron in your portfolio? Or Exxon with one of their ETFs, we need to know that. And so as an advisor, being able to assess and understand what's most important, what are you trying to accomplish, and then you can map that to what the appropriate output is. We can't just say, you're an ESG investor, and therefore you're going to go into this bucket of a application of what that means. We need to figure out the input so we can create the right output.
And then is morality a part of that conversation also? Because it's some of these things, like what you're doing at Exxon, helping to create these changes, like oil and gas companies aren't ever going away. They're going to have to evolve, right? So is it helping the client then understand that, look, investing in these companies could be a good thing. It could be a way for you to help institute change through capitalism.
Again, do you want to be that engaged shareholder, or do you want to screen it out of your portfolio, right? But we have to ask the question. And so there's no right answer. It's really just about what's the approach you want to take, and what is the investment thesis behind that? There's an investment thesis behind we're going to have exposure to fossil fuels because it exists. It's going to continue to exist. There's also an investment thesis to not having it in your portfolio. So what is that investor trying to accomplish?
Right.
I just want to add one point, because this is something I'm actually deeply passionate about, which is I don't believe that most retail investors are aware of the power that they have collectively.
100%,
And it's really
I agree.
frustrating to me because in my prior role at a large asset manager, we'd get institutional requests for proposals all the time. And those institutional clients would ask, what's your proxy voting policy? How do you, like, what type of shareholder proposals do you support? What do you not support? And they were very thorough. It was part of their due diligence mechanism to understand how the assets that they were giving to a manager were being used on their behalf. And the reality is that every year there are tens of thousands of proposals that come up to vote at the largest companies. You as a shareholder are not just entitled to a right to their profit, you're entitled to a right to influence their companies. And I think in narrowing in on this topic, there's several hundred every year that relate to really important environmental and social issues. And so the key to this all is that actually most people don't invest directly in companies anymore, or most retail investors, they invest through managers. So when you invest in a manager, you are effectively delegating that vote to them. They are the shareholder. And so this, to me, is a new part of what's going to happen. I think in the institutional landscape, it's very clear that ownership and stewardship is an important part of the due diligence process. In retail, it used to be about, particularly in low-cost market cap, what's your cost, what's your size? There's a whole other area. How are these assets being used for influence? Does it align to what I believe in? Does it align to where I see economic value? And I think this is the way advisors can add a lot of value, because this is a confusing conversation for anyone. It's very confusing for end retail investors, and this is where I think the simplification of it is powerful. But we can, that's a lot of assets. There's $7 trillion in ETFs right there. So
I love that you said that, and that's why I'm so happy to be speaking to this audience. I think this audience and advisors have a lot of power and also a lot of responsibility and a lot of opportunity to tell better stories. That's the core of it, is for personalization, for values-based investing, and for ESG, how do you help your clients understand what it actually means and what's going on? So my company, Your Stake, does have reporting on shareholder engagement, where we're looking at what these fund managers are doing, and we're helping advisors communicate that in easy ways, because it's really not super intuitive. People don't know that there are votes going on and their investment managers are speaking with companies. So it's really important for advisors to be able to make that clear. And that's what we're really focused on, in the storytelling on the engagement side, as well as here's the story of how divesting from Exxon is meaningful and aligns with what you care about. Here's the story of how engagement works. That's what I think can help the field scale and put people in the solutions, like Zach was saying, where it actually fits with your theory of change and your idea of who you want to be as a person.
Could I just add something quick?
Sure.
Sorry. So I'm an advisor by background before we started Seeds, and this idea of storytelling and value delivery, from the advisor to the end client. In our business, it was, how do you assess an investor? You assess what's their risk tolerance and their time horizon. You put them in a model portfolio, and then your value is defined by basically what the markets are doing in a given quarter. You're talking about performance, right? And so to unlock at the front end of that assessment experience, who are you really as an investor beyond risk tolerance and time horizon, and then implement the right solution, and then walk into a client review meeting to tell a much more engaging story, because it's going to be engaging because you figured it out the first day you met with that client. It's just a totally different, more engaging experience.
Yeah, it really comes down to the conversation with the client too, and really understanding them. And that really drives business too for all FAs in general. And at Ally, we're building a small wealth management business, and that's at the center of it, is really understanding the customer's needs and wants and desires. But actually that was a good transition, because I did want to tie into risk tolerance with you, Ari. But before I do it, just a reminder, I know we got one question on the board here. Slido, get on your app. If you've got any questions for these guys, we're happy to answer them. So risk tolerance, how do you tie that into the equation? Because it is really important. Do you just start with that, what's your risk tolerance, and then, you're building products, so how do you think about it?
Yeah, again, it comes down to, what the preferences are of the client. You have to manage ESG preferences along with investment objectives. So if it's low volatility or it's value-based strategy, how do you incorporate or integrate ESG and still get those factors in? From a risk tolerance perspective, ESG does a good job of identifying kind of those disaster scenarios. Companies that rank well on ESG metrics typically aren't going to have big social issues or environmental issues occur within the company. But that's not going to lower the overall volatility of the portfolio. So you really have to kind of target what is my investment objectives, what are my ESG objectives, and how do we integrate those. We work with a lot of large institutional clients who sit down with us and say, hey, we want to reduce carbon intensity by X amount in the portfolio. We want to target a volatility of 6 to 9%. So we have to kind of sit there and look at the overall strategy, what the ESG preferences are, and then how do you integrate those.
And you're working with big institutions. Again, it's creating these products that large money managers, it's their perspective that you're trying to fulfill, even though the end consumer is an individual investor, financial advisor trying to sell this product to an individual investor. How do you have different conversations when you're creating new products for these managers?
Yeah, I mean, the conversation's always different.
Does it even come up?
If you sit down and have an ESG,
matter?
you don't have the same ESG conversation. As we've said earlier, ESG is such a broad term, and it encompasses so many things, so every conversation is different. Yeah. I think we've said this multiple times now, but just really understanding whether it's an advisor or a large institution, what are the preferences, and then how do we properly reflect those in the investment strategy?
Okay. Well, let's take some of the questions from the audience. Any thoughts on anti-woke products like the Strive ETF, and how to wade into having constructive conversations with clients? Anyone want to take that? You, Zach?
Okay, sure.
You nodded your head yes.
Yeah, I'll give it a shot. So I think it goes back to, again, even the term ESG at inception was about materiality, right? It was about material risk mitigation related to these issues. So there's a lot of sort of rhetoric right now around, anti-woke approaches and even products coming out as a result. And I just go back to, this isn't fluff, right? There is a true investment thesis behind this application, right? No one can argue that, the governance of a company is immaterial to the outcome of that company. Or if you treat your workforce terribly and get sued and have, unionized issues and all these different things, that's not going to affect shareholder value. So I think making it clear, and again, it goes back to what does the investor care about? Are they more interested in what should be that underlying risk mitigation thesis, or are they more interested in sort of the values alignment piece? And both of those things can come together, but understanding what they're looking for and what's important.
Maybe just one thing I'll add to that is, and maybe to zoom out more to the system level, I think one of the things that has changed quite profoundly in the last couple years is a move towards transparency around stewardship in general. And I think this is critical because if you actually think about it, or you look at the regulation, asset managers are not required to disclose how they vote in proxies for, in many cases, several months after they vote. And so, to some extent, I think there may be a systems thing happening right now where the idea of more choice for investors around policy approaches and stewardship approaches that better fit them is a good thing, and also more transparency. So bringing this conversation more to the forefront. I will say, we do that. Like, one of the things we focused really heavily on was disclosing our votes on a real-time basis right after we voted a company meeting, because I would love our shareholders to look at our website and say, why did you do that? Or what's your viewpoint here? And I think that's actually maybe one of the benefits of some of this divergent conversation happening, is it's actually becoming more to the forefront. And my hope is that we just see more and more transparency from managers on how they approach these questions.
When you have the SEC engaged, you have the government engaged, you have local governments engaged in really having these conversations, making sure companies are disclosing more and more information, being more and more transparent about a lot of these topics. But still, at the end of the day, like a Tesla might be doing something really great from an environmental perspective, emissions perspective, but on the other hand, there are other issues that don't necessarily align, and so and you kind of touched on this earlier, Yasmin. It's a weighting issue. Then it becomes a real qualitative issue, not a quantitative issue, which makes it much more difficult. And of course, there's several rating agencies out there, 2 or 3 that really get garner a lot of the attention. Ari, I know you did some work on the diverging performance of the ratings of each of these bigger institutions, the bigger rating agencies. How does that evolve over time? Is it do we need to have one, there's three major rating agencies, right, for debt. Is it come down to like that ultimately at the end of the day from when it comes to ESG?
I'm actually I'm a big advocate of disclosure and actually mandatory disclosures. Until we get to a point where we have quality data, we can't answer, questions like statistically is ESG a factor? Will it provide long-term, performance? And it starts with the data, and most large companies disclose, but a lot of smaller companies don't disclose their ESG risks and opportunities. So I think until we get to a point where it's mandatory to disclose ESG risks like you have to disclose your financials, I think that's really step one. And then getting to a point where this standard disclosure will lead to better quality data and I think better ratings over time.
Gabe, do you think the standard disclosure in Europe, I think you talked about MiFID II before, could that be a framework that the US uses?
Yeah, I'd be really happy to jump in on that. So in terms of standardization of the ratings agencies, where I see the space moving is more towards the actual data, because that's what investors can resonate with, and that's what people can care about. Is the actual data of your toxic air pollution in poor communities, is the women in leadership positions. That's what people understand instead of an 8 out of 10 ESG score. So even if you have a really great methodology, that's what people resonate with. In the US, the SEC has proposed rules around enhancing disclosure. And in Europe, as you mentioned, there is a lot of regulation coming out where there are specific indicators that every company will and fund manager will also have to disclose. The piece that I wanted to touch on, though, with regards to MiFID, is actually a regulatory requirement in Europe that is also just a fantastic client experience anywhere in the world. And in Europe, with this new MiFID regulation, it went into effect at the beginning of August. Every single financial advisor needs to talk to every single one of their clients and figure out, one, what are your preferences? That means both risk tolerance and sustainability. Two, how can we find a product that best matches those preferences, risk tolerance and sustainability? Three, how can we report on how our product matches your risk tolerance and your preferences based on sustainability? So that's actually something that we focus on a tremendous amount at Your Stake, my company, is helping with that exact experience of what are the issues you care about, what's going to be the best fit portfolio or design your own, and then how do you report and actually prove that you are creating better alignment. And that requires not more ratings and not more rating agencies with new methodologies, but that requires the actual raw data and transparency and displays of showing exactly what's going on and why this is a good fit for you.
Yeah, exactly. Let's take another question from the audience here. Many investors are looking to make an impact in their local communities. How can advisors work with their clients interested in place-based investing? Anyone want to jump in?
I'll jump in. There's a platform that I don't know if anybody in the audience has heard of called C-Note. So CDFI investing, so very clearly local community investing. And, but if you kind of zoom out and think of if somebody has X amount of dollars to invest and they're saying that that's important to them, and so therefore, how do you solve that specific thing that they're trying to accomplish with their money, but then also make sure that everything else in that pie chart is generally in alignment with that as well?
Yeah.
Right, so we always see that disconnect. We see it in the industry in general when it comes to things like charitable giving. Most of our advisory clients are charitably inclined. They're doing impactful things in their communities, volunteering, making impact investments. And then you look at their long-term stock and bond portfolio, and it's literally doing the exact opposite in the world. So I think like a singular thing like that someone's trying to accomplish, you need to solve that. And there are platforms and different specific solutions to do that. But then making sure that that total allocation is pointed in the same direction and not the opposite as well.
Yeah, I think that's a really important point. Is it's part of their entire financial picture, so you have to look at it that way. And oftentimes people don't necessarily think about that. And so as a financial advisor, you're here to kind of guide them down that path for sure. I think too, as we get to the end of this conversation, it's really just let's just go down the row. What is your best advice for financial advisors that are really trying to truly help their clients align their personal values with their investments? What would you say to these financial advisors? What guidance would you give them? Ari, you want to start?
I mean, I'd start with education is key. Really understand your client, what they're trying to accomplish, and make sure they understand what ESG is. That term, Zach kind of touched on this earlier. I think we've done a little bit of disservice to investors in really shoving everything under the term ESG. And so really helping them understand what is impact investing, what is engagement, what is the different types of environmental or social or government strategies that they might be interested in. But it's really education there. That's where it starts, in my opinion, and make sure your clients understand, A, what are their values, and B, what's available to them and what the differences are between all these different types of strategies.
And it probably gets back to knowing the why you're investing in that strategy, not just because you see that it's cool, trending, a lot of money's going to it, so that's what I need to do. Does it really fit what your passions are, what your goals are, what your risk tolerance is, all those things we talked about too. But Zach, go ahead. What advice would you give?
Yeah, it's to ask the questions, right? Our tagline at Seeds is just knowing what matters most. Mm-hmm. So when you walk in the door, I can't just know you based on your risk tolerance. I have to actually understand what you're trying to accomplish with your money and in the world. And so I need to ask the question. I need to take you through a deeper, more engaging assessment experience to capture that multidimensional view of who you are so I can create the output, right? If we talk about best interests for our clients, and you have somebody who's on the board of a nonprofit, and then you're putting them in a portfolio that is, again, doing the opposite in the world, you didn't ask the right questions at the start of the relationship. So really just encouraging advisors, you need to ask and then deliver the solution on the other side, and that's what we're trying to do at Seeds.
It can be like super empowering too for the advisor to have that conversation. You truly feel better about you're helping this person achieve their goals in the right way and the way they want it done too. So,
exactly.
But Yasmin, what's your advice?
I guess I'd say I think this, I guess that's the challenge right there. This conversation is relevant to everybody, and I think that's one of the holdups here is that my guess is advisors feel they're a little bit trepidatious of introducing it because it's such a lightning rod issue area. And there will certainly be some segment of their client base where it's very clear. It's a values alignment conversation. You can sort of get the answers and make the portfolio match. But I think there's actually huge investment opportunity here, that if you don't ask the questions, you're actually missing out for your clients. So because I'm a person who loves statistics, I'll just say it, like the energy transition feels very polarizing on one hand. On the other hand, by some accounts, some firms, McKinsey, I'll say, reports it's going to take $3 to $5 trillion a year to think about decarbonization. There are so many profound investment opportunities around that. And so this is not just a conversation of morality. It is very much a conversation of investment performance. And so I think with actually an entire client base, there is a discussion to be had, especially if you can try to think about how to create the linkage to how some of these issue areas are relevant to how companies will do and industries will do over time.
Can I just quickly add, I think, advisors are looking at their books of business and saying, these are my ESG clients and these are my traditional investing clients. And very often they're wrong, right? Because they're thinking of ESG in a particular way. But look at everybody the same way. They're a blank slate. Figure out what's going to resonate with them and then deliver the solution.
I think my fellow panelists really covered it very well. I'll just add one last thing, which is investors that are more engaged with their investments because there's that value alignment, they're better investors. They're not going to pull out when things get tough. They're going to be more excited about investing more and putting more into strategies that they're aligned with. So I think there's a lot, not just from a values and impact perspective, but from just being better investors, this is a really important conversation to have.
You can engage them without taking up a significant amount of their time by holding their hand throughout the process. The other thing, Yasmin, you mentioned to me when we were on the phone was just how this is an opportunity. It's not just about seeking alpha, right? This is an opportunity for financial advisors to meet new clients, new generations, right?
Yeah. I mean, and to some extent, I think the conversation has been so polarized in the last year that it feels like people have to play defense on it versus offense. But one of the most interesting things I heard from another advisor was that, I mean, we hear this a lot, the next generation of wealth, but even beyond that, like establishing a relationship with the general family is so important, as you all know. And this may be a way to actually bring people into the conversation, other family members into the conversation who have not historically been involved in that conversation. And why does that matter to businesses? Well, client retention, right? Like there's a real business case. You can
Sorry, I don't know if it was a wash in my hair.
for dramatic emphasis. There's a real business case that can be made around how for significant others or for next generation of wealth, this is a way to pull them in early so that, as wealth passes and through different generations, you've established that relationship and talked about things that are important to the broader family unit.
Anything else to add? Did we cover performance enough? I know we have a couple minutes left, so I want to make sure that that we covered everything from a performance perspective. Or I think this bug is still in my hair.
There it is. Oh,
I don't know what to do.
I see it.
Oh my God.
Oh no.
Somebody.
Yeah, somebody. Oh my God, that was a big bug.
Thank you.
What does it mean?
So big. Oh my God.
It's a metaphor for something.
Sorry, I didn't mean to leave you guys hanging.
That was
The most
dramatic.
entertaining stage. All right.
Woohoo! I'm okay. Give a little more, oomph to my hair.
Very impressive.
All right, let's finish this conversation though up with. I guess we're out of time. I think I lost my mic too. I don't know if it's working. Sorry, that was the dramatic way to end this segment. I apologize for that. But thank you all for your time. Thank the panelists here. Really, really smart insights. I told you at the beginning this was going to be one of the most insightful panels that you watch all day, and I think it was. I hope you're pleased and you learned a lot. These guys will be around after if you have questions for them. So thank you all.